And welcome back to another video on how to become or how to secure yourself financially. So we're looking at the investing classroom from Morningstar, this North American financial firm that offer an arrangement of service to manage a portfolio and also educational content like this. So by looking at the featured content here, the TLDR, or the things to know about staying invested in the market, is that stock has provide highest return and the increase in the wealth over time. Also, that investor must have discipline and patience. By looking at the crisis and the long-term performance of the markets, holding on can pay off in the long run. And also see how small cap stock perform after the end of a recession. And on average, the accumulated return by small stock outperform those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession, according to Morningstar. And also, what is the interest rate? A simple example of interest rate. The interest rate is just the money or is the cost of borrowing or savings you will earn. And the simple example is that if you offer, or let's say you ask 100, if you, let's say you borrow 100 for someone and that person set 5% as the interest rate, you will have to pay them 150 $105 maybe $105 in total. Or if you deposit 100 in a saving account and the interest rate are 5% a year, well, you were able to earn $105 at the end of the year. So I also look at that. What is the loanable fund markets, where you see all of this interest rate reflecting loans of different time length and risk. Understand the different type of short-term interest rates, such as federal fund rates, the treasury bills, and 1 year government maturity bonds. And the treasury bill, which is what we care about, is a shorter interest rate, meaning 1 year or less is an interest rate applied 1 year or less that is used for commercial banks to lend fund each others. So the Fed wants to achieve that federal fund rate target by buying and selling securities. The security is just a financial asset that is tradable and fungible that holds some monetary value, right? The type of security can be depend on the owner perspective. Uh, if that security allows to have participation or own things in a company or stocks, is called equity, or is called uh, stocks. Whereas when the owners is entitled to a principal plus an interest rate, it is also called as a debt holder. So there usually are called bonds. So the financial instrument, or this security, allows to efficiently transfer uh, value or capital through financial system for the most profitable users. So going back to the Federal Reserve, which after all they tried to achieve the federal fund rate by buying and selling securities in the open federal market, right? So the Fed, which was founded in 1913, there's an interesting story before the creation of that. The bank worked in 1850, where most of the uh, sorry, where most of the Latin country or these nations republic in Latin, they starting to shackle their oppression from uh, Spain, basically, or Portugal, right? But in any case, the thing here is that the Federal Reserve, which has a couple duties, set the discount rate, something I'm going to talk about that later, set the discount rate, the the prime rate, which is the rate at which commercial banks charge to their most credit-worthy client, such as uh, company usually. It also oversees the national banking system, set monetary policy, aka print money, and it also buys and sells government security in the federal open market. So, like the stock market, the bond market is also affected by the state of the economy. Specifically, the interest rate in bonds are affected by the demand of loanable funds. So during a contraction, the demand for loans falls, so the Fed lower the interest rate to stimulate consumer spending and to reduce the cost of borrowing. And during an economic expansion, the Fed wants to the the interest rate uh, rise first to control the monetary supply and also to keep inflation at check. Okay, that's why I look at the market in terms of recovery here, where by looking at this bigger picture of how the market has been performed over the past years, over the specifically the last 49 years from 1973 to 2021, and see that they have happened or they have been 10 market contractions, which each one of them mark the end of a market stock cycle. The cycle meaning is a complete round in a price security of a stock price. I mean, this cycle is a complete round of a stock price fluctuation, right? These cycles may vary in length and time and durations, and they happen at random phase, at least these contractions, and they are defined by when the market stock price peak fall 10% or more. And during an economic expansion, it measure is the recovery of an index or this long or this boom in security following a long decline. The term recovery is also used to describe the nation's activity economy. So measure the recovery of an index. This is statistical reference expresses a percentage uh, of investment in a period of time where the whole goal of this is to measure progress. So by looking at the recovery of an index from the very bottom of the contraction to its previous peak and the subsequent performance until a next level peak before a decline, that's the whole idea of this recovery. right? So that's a recovery. When you talk about recovery in the finance, it's like, okay, so they measure this a particular index with respect to this previous peak stock price level, how that index will perform until the next peak level before a 10% decline. So knowing that, all right, and the things to know is that investor should have a long-term investment horizons to allow their investment to grow. One, and then you have is the market contraction and expansion. The market downturns and recovery. This is the thing that struck me the most because here I saw how the U.S. equity market has passed through several downturns or crash, okay, bear markets, and the most severe was in 1929 at the start of the Great Depression, when the stock lost over 80% of their value, specifically 83.4% of their value, uh, and the recovery took 12 years. So this U.S. equity, and the term equity means the total amount of assets minus its liabilities, the net worth or capital of a business, the total amount of assets, stocks you own from a company, or in the context of property, is the total amount or total value of that property minus its liens, minus this legal right of someone else to possess your property until an obligation is met or a debt is repaid. There are several types of these liens. You can have bank liens when you ask a loan for a bank to purchase a car. Okay, uh, they issue this lien in case you are unable to pay that, because in that case, well, they seize your vehicle, resell that to repay the debt, right? And whatever business it can emerge from that, but that's another thing, right? Uh, you also have judgment liens, where a judge can seize your assets, specifically in a lawsuit. So a judgment liens can get a defendant in a non-payment case to liquidate all of your assets, all of the accused assets. Also, we have is the real estate liens, uh, that the mechanical lien, but the real estate liens as well, where you retain or where there is a lien on a real estate property, okay, if a contract is not fulfilled, right? So the most common use case here is with bank. When they anytime you ask for a mortgage, they automatically generate a real estate lien on that property, right? So if you're unable to pay, they can easily seize your assets. Of course, there is a process in between, but if you're unable to demonstrate that you're able to pay that, all right, so they will seize your assets and uh, they will seize your assets and uh, repay the debt allegedly, right? Or do any business in between. We also have these mechanic liens where it's a guarantee to constructors, construction firms, builders, or a contractor that an owner is going to pay them for service rendered. It also can be attached to a real estate property, and if the owner is not willing to pay them, then you can go to a court to start a lawsuit, and then go with the judgment case, right? And also you have is the tax lien. This is something that is not created by contract, but by the law. And the most common scenario is in the taxation field, where in the case of the US, if for some reason you become a taxpayer delinquent, okay, and you not show them that you want to pay that, they can issue a legal claim to seize all of your assets, all of the accused assets, such as your home, vehicles, and bank accounts, right? So things started to get interesting. But again, from the Investopedia documentation, they say that well, this is the last resort from any of these tax authorities, the IRS, for example, the Internal Revenue Service. So knowing what is liens, right, and what is equity, then I also look at the market or the downturns with respect to some asset class, such as bonds, stocks, some other asset classes with some sample portfolio, and see the correlations of some assets with a broader market, right? So by looking is at the bond yield after the end of a recession or during a recession, bond yields during recessions, there are factors, there are driven factors such as the demand and supply for loans, the monetary policy, and the or inflation expectations. So the Fed has a set of tools like the discount rate and the federal fund rate to set this monetary policy. Okay? So the discount rate is either the interest rate that the Federal Reserve charge bank for shorter loans, meaning loans for 1 year or less, right? Or is the interest rate used on the expected discount future cash flow? So this discount discount cash flow. I mean, discount is the expected discount cash flow. Okay, and this is just an evaluation method. This discount cash flow is an evaluation method to know the value of an investment today based on its expected future cash flow. So when I look at cash flow, is the movement of money in and out of the company, and to know more dive deep into this is to understand now is to understand now uh, yeah, is to understand a beginner guide to financial statement. Why? Because okay, I know what is cash flow, and in the Wikipedia mentioned there are several types, or is most of the time is categorized on uh, investment, financing, and operation. And to me, it's like okay, because they mentioned that statement and they put a source. So I click on that source to look at the beginner guide to financial statement. This is come from the sec.gov, and well, they tell you if you're able to read nutrition labels or read a box or baseball box score or soccer box score, you can read and you can learn to read the basic part of financial statement. If you can follow a recipe or apply for a loan, which is something that is quite time consuming, you can learn the basic of accounting. And the basic is not that difficult. And there are rocket science. So in that section, they show us how to read basic part of financial statement, just like a CPR class teach you how to perform basic cardiopulmonary resuscitation. So by looking at this way, or by understanding is the basic part of how to read a financial statement, it won't try you to be an accountant, just like the CPR course won't teach you or will make you a cardiac doctor. Uh, but it can give you the confidence to be able to look at a set of financial statements and to make sense of them. To say, oh, okay, great. Uh, so understanding what financial statements are is just they show you the money, right? So I don't know if you saw this Jerry Maguire movie from the Cuba Gooding Jr. Immortal Lines, like show me the money. Well, if you're not, doesn't matter. If you do, that's exactly what financial statements do. They show you the money, where the company money came from, what is it now, and what it went. And there are four basic, or there are four main financial statements. You have balance sheets, cash flow, income statements, and statement of shareholders' equity. Okay, so the balance sheets show what a company owns and what it owns at a fixed point in time. The cash flow show the exchange of money between a company and the outside world, and the income statement show you how much money a company made and spent over a period of time, and the statement of shareholder equity show you the change in interest of the shareholder over time. All of these uh, statements are based on time. So when you look at the balance sheet, which is the first statement, so it is a detailed explanation about the company assets, liability, and shareholders' equity. So assets are anything that a company owns that has value. Keyword here, value. Owns a value. Whether it is used to be sold or it is used to make product and service that can be sold. This is something crucial and critical here. Okay? So you can have these tangible or intangible assets. So tangible are anything like your equipment, inventory, buildings, land. Whereas intangibles are like trademark in uh, trademark and patent. Okay, and that distinction is something very important, because most companies that are having tremendous success, they have that patent, because that's the business, the patent or a trademark, right? And also you have to make that sustainable. That's another thing. So then I look at the liabilities, which is the amount of money that a company owns to others. Uh, and this can include all type of obligations. For example, money that a company owns to suppliers, loans, uh, uh, yeah, or borrow money borrowed from a bank to launch a new product, the rent for use a building, the payroll a company owns to its employees, environmental cleanup costs, which is something interesting, funny, and not that funny for the people of Ohio. It's like, oh no, man, this is not Ohio. where toxic train broke down 2 days before Ohio derailment. From New York Post, right? So you have this. Uh, so I won't show you too much because perhaps I will receive a hit from copywriting. But yeah, this is something that happened in Ohio, and now that company have that liability, have that kind of liability. Okay, the environmental cleanup costs or tax owed to government. So liabilities is also obligations to provide good or service to customer in the future. Okay, for example, insurance, right? So once you sell a car, another liability is the insurance. Perhaps you also have links or trades, or perhaps you own a insurance company with a manufacturing car, you know, uh, and when that's liabilities, and then you have shareholders, which is also known as the network capital, and it is the money that will be left if a company sold all of their assets and pay off all of its liabilities, right? Basically that. So the leftover money belongs to the shareholders or the owners of the company. There is a formula here, which is the assets in the balance sheet. The assets is equal to liabilities plus shareholders. In a balance sheet, you may find assets listed on the left side and liabilities and shareholders' equity on the right side. Also, you can see is all of the company asset list on top, followed by a liabilities and shareholders' equity. Okay, and assets are generally less based on how quickly they can convert into cash. So you have current assets and non-current assets. So current assets are any or things that a company expect to convert into cash within 1 year. So for example, inventory. Okay. A non-cash or non-current cash is anything that a company expect to sold or to convert to cash in this case uh, for more than a year when it is difficult to sell that within a year, right? Inside of this, we have fixed assets that allow a company to operate their business and they are not for sale. For example, furniture equipment, trucks, and other property. In my case, it's like my laptop, keyboard, mouse, cell phone, the internet to provide my service. So you also have liabilities. These are listed due their due dates. So you have is current liabilities, obligations that a company expect to pay within a year, to pay off within a year, uh, and long-term obligations uh, do more than 1 year away, right? And shareholders' equity is the amount of owner. The shareholders' equity is the amount owner invests in the company stocks plus or minus the company earnings or loss since inception. Okay. Another way to look at this is uh, the company earning or loss from since inception Uh, is it is so the amount investment so the amount investment or the amount owner, because I would like to look at things at different angles here to play devil advocates here. Okay, so the amount owner invested. Mhm. So the amount owner investment. So the amount owner invested in a company stock plus or minus the company earnings or losses since inception. Okay. Another way to look at this is the total amount or is um, so company stocks. Okay. The DM. So the company earning or losses from its since inception. Okay, so the company earning or losses since inception uh, is the amount of money investment of the owner in a company stocks, right? You can mention that. So the company earnings or losses since inception is the amount of money investment from owners to to company stocks or in the company stocks. Okay. In other words, is the amount of owners investment in the company stocks plus or minus the company earnings or losses since inception. Okay? So sometimes company distribute earnings instead of retain them. And these distributions are called dividends. And the balance sheet shows you a snapshot of a company assets, liabilities, and shareholders' equity at the end of a reporting period. It does not show the flow into and out of account during period. Okay. A balance sheet. So a balance sheet show a snapshot of a company. So balance sheet. So what is shareholders equity? Well, is the total amount, or is the amount of investors, or is the amount owner invest in a company stock uh, plus or minus? Okay, is the total amount of the is the total amount investors? Okay, is the total amount investors own? Is the total amount owner invested? Mhm. Is the total amount owner invested in the company stocks? Okay. Uh, yeah. Is the total amount owner investment in the company stocks plus or minus the company earnings or losses since inception? Okay. Uh, Sometimes a company distribute earnings, and this is called dividend. Okay, so balance sheets show you a snapshot of a company assets, liabilities, and shareholders' equity at the end of the reporting period. It does not show the flows into and out of the accounts during that period. But this balance sheet show you is a snapshot of the company assets, liabilities, and shareholders' equity at the end of the reporting period, right? So it does not show the flow in and out of account during the period. So okay, cool. Mm, Okay. All right. Okay. So now I'm going to read about income statement. Okay, to make this TLDR. Using the Pareto principle here to know this. Income statements are an income statement is a report that shows how much revenue a company earned over a specific period of time. How much money a company made over a period of time. Usually for a year or some portion of a year. An income statement also shows the cost and expense associated with earnings that an income statement also shows the cost and expense associated with earning that revenue. Okay, okay. So income statement not only show you how much money, how much revenue money. So income statement not only show you how much revenue a company earned over a period of time, but also show the cost and expense associated with earnings. Associated with those earnings. Okay. The little bottom line of the statement, the literal bottom line of the statement usually show the company net earning or losses. Okay, the bottom line of the statement usually show the net earning or losses. So by looking at the EBN, an example of that, IBM income statements. Well, so income statement here, International Business Machines Corporation. So we look at the income statement here, like this. Okay. Total revenue and gross profit. Mm-hmm. Okay. Okay. Um, so yeah, this is the income statement, like that. An income statement also shows the cost and expense associated with earnings that revenue. The literal bottom line of a statement usually shows the company net earnings or losses. This tells you how much the company earned or lost over the period. Income statement also report earning per share. Earning per share. These calculations tell you how much money shareholders will receive if the company decides to distribute all of the net earning for the period. So income statement also report earning per share. This tells you how much the company earned or lost over the period. Okay, so they don't tell me is that they show me is the total revenue, operating expenses, tax, provision, diluted, basic diluted, normalized income, interest expense, net income from continuing operation, normalized ABT. What the hell? Mm-hmm. Total unusual items excluding goodwill. Okay, let's go to keep reading here. So yeah, this is income statement. Blah, 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 blah. There you go. So to understand how income statements are set up, think of them as a set of stairs. Like this. To understand to understand how income statements are set up, think of them as a set of stairs. Right? You start at the top with the total amount of sales made during the accounting period. Again, income statements also reporting earning per share. This calculation tells you how much money shareholder will receive if the company decides to distribute all of the net earning for the period. Okay, if the company decides to distribute all of their net earning, their capital, in a period, that is the EPS, the income statement. Also report earning per share. Report earning per share. EPS. Okay. Earning per share. Holy crap. Oh my god. The delusion and the for real? Damn, you gotta be Internet Business Machines Corporation. But this is expressed all number in thousands. So you're going to receive is just $6,000. You gotta be basic EPS, diluted EPS. What? For real? Okay. Income statements also report earning per share or EPS. This calculation tells you how much money shareholders will receive if the company decides to distribute all of the net earnings for the period. Mhm. So this is income statement. Income statement. Also report earnings per share or EPS. This calculation tells you how much money shareholders will receive if the company decides to distribute all of the net earnings for the period. So if the company decides to distribute all of their net earnings uh, to all of their shareholders, that's the amount. Company almost never distribute all of their earnings. Usually they're reinvesting in the business, which is something that we as an individual should do. Reinvest in ourselves. Reinvest in ourselves. Thanks, business. Thanks. Thanks to know and to indicate me to give more guidance and lights about what should I do in this game of life. Right? In the moment, in the historical moment that I'm living right now in 2023. Yes. Okay. So income statements is a report that show how much money a company made, and also the cost and expense associated with that earning that revenue. Okay, so an income statement is a report show how much revenue a company earned over a specific period of time, usually a year or some portion of a year. Okay, or some portion of the year. So you have is the QA, for example, annually, quarterly. You know, you have annually and quarterly. Okay, and again, what I'm doing is just mimic this behavior from them. That's what I'm doing. It's like mimic this behavior from them and see how can I apply that to my own, right? Okay, okay. Interesting. Interesting. Mhm. Okay. Mhm. Mhm. So the income statement is a report that shows the revenue a company made over a specific period of time, yearly or quarterly, or some portion of the year. Okay, yearly, quarterly, or some portion of the year. An income statement also shows the cost and expense associated with earning that revenue. Okay, exactly. An income statement shows you the cost associated, uh, the cost, the cost and expense associated with that, with earning that revenue. Uh, so the literal bottom line of the statement shows the company net worth, show the company net earning or losses. This tells you how much the company earned or lost over the period. So you have income statements also report earning per shares. Okay, that's earning per share, and these calculations tell you how much money shareholders will receive if a company decides to redistribute all of their net earning for the period. Company almost never distribute all of their earning. Usually they reinvest them in the business. You know, I'm not going to distribute all of my earning. I'm going to reinvest in myself, in the business. To understand how income statements are set up, think of them as a set of stairs. Okay, you start at the top with the total amount of sales made during the accounting period. Okay, you start at the top with the total amount of sale made during that period account. Then you go down one step at a time, and each step you make a deduction for certain cost or other operating expense associated with earning the revenue. At the bottom of the stair, after deducting all of the expense, you can learn how much the company actually earned or lost during the accounting period. People often call this the bottom line. Mm, holy cow. Okay. Holy fudge. Interesting. How they even, by using real life examples, they tell you this. And the basic is not that hard. There are rocket science. Nigga. Holy. At the all the top of the income statement is the total amount of money brought in from sales of products or service. Okay, at the top of the income statement is the total amount of money brought in from sales of products or service. This top line is often referred to as gross revenue or sales. It is called gross because expenses have not been deducted from it yet. So the number is gross or unrefined. Exactly. So you have this, for example. At the top of the income statement is the total amount of money brought in from sales or product or service. Exactly. You have the total revenue, no operating revenue, right? And then think of that as a stair. You start from the top, okay? You start from the top with the total amount of we'll start with the top with the total amount of sales. With the total amount of sales made during that period, annually or quarterly, okay. Mhm. And then you go down one step at a time. At each step, you make a deduction for certain costs, exactly, and then you go down step by step. And each step, you make a deduction. Okay, you make a deduction. Mm. And you make a deduction for certain costs or other operating expense associated with earning the revenue. associated with earning the revenue. At the bottom of the stair, after deducting all the expenses, you can learn how much the company actually earned or lost during a period of time. People often call this the bottom line. The bottom line. How do you define this? The bottom line, Spanish, tocar fondo, might be. Bottom line in Spanish, balance final. Interesting. The bottom line. Okay. Okay, the bottom line or balance final. Mm, it's funny because they don't calculate this. You know what? They don't calculate this. Total expense. Ah, there you got it. Total expense. Okay. Total revenue and total expense. Dang. So IBM is barely making money. Well, no, because after all numbers are in thousands. So they're not barely making money. They are making money. They are making money. Jesus freaking Christ. Okay. Oh my god. Oh my god. Holy crap. Okay. This has been a very, very interesting. Oh, this has been a very, very interesting video, man. So, holy crap. Okay. Okay. Uh, Let's going to keep reading about this. At the top of the income statement is the total amount of money brought in from sales or is the total amount brought in from sale of products or service. This top line is often referred to as gross revenue or sales. It is called gross because expenses have not been deducted from it yet. So the number is growth or unrefined. The next line is money. The company doesn't expect to collect on certain sales. This could be due, for example, to sell discount or merchandise return. When you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. It is called net because if you can imagine a net, okay, the next line is money the company doesn't expect to collect or certain sell. This could be due, for example, to sell discount or merchandise returns. When you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. It is called net because if you can imagine a net, these revenue are left in a net after the deduction. That's one of the reasons why they call net word. Okay. And a net is, in Spanish, it is una red, right? Exactly, like a fishing net. In Spanish, it is a malla, una malla. So it is called net because if you can imagine a net, those revenue are left in the net after deductions from returns and allowance have come out. Moving down the stair from the net revenue line, there are several lines that represent various kind of operating expense. Although these lines can be reported in various orders, the next line after net revenue typically shows the cost of the sale. After the net revenue, so you have is the cost of revenue, gross profit, net revenue. Net income, perhaps it's net income, net interest income. Interest expense. Let's going to keep reading. The next line subtract the cost of sale from net revenue to arrive subtotal called gross profit. You have is a gross profit, but they don't show that gross profit because this is not in their interest to show that data. Spawn all, collapse all. And it is not in their interest to show all of this data. Operating expense, gross profit, and then you got it. You got the cost revenue, and then you have moving down the stair from the net revenue line. There are several lines that represent various kind of operating expense. Although these lines can be reported in various orders, the next line after net revenues typically show the cost of the sale. This number tells you the amount of money the company spent to produce the goods or service it sold during the accounting period. The next line subtract the cost. The next line subtract that the cost of sales from the net revenue to arrive the subtotal called gross profit. And so gross profit is this. And then you call here is, or sometimes gross margin. Gross revenue, cost of revenue, or gross revenue. It's called net because if you can imagine a net, this revenue are left in the net after the deduction of for returns and allowance have come. Cost of revenue. Then you have gross profit or gross margin. It's considered gross because there are certain expenses that haven't been deducted from it yet. The next section deals with operating expenses. These are expenses that go towards supporting a company operation for a given period. For example, salaries of administrative personnel and costs of researching new products. Marketing expenses are another example. Operating expenses are different from cost of sale, which were deducted above because operating expense cannot be linked directly to the production of the products or service being sold. Depreciation is also deducted from gross profit. Depreciation is also deducted from gross profit. Depreciation takes into account the wear and tear of some assets, such as machinery, tools, and furniture. Okay, depreciation, which are used over the long term. Companies spread the cost of these assets over the period they are used. This process of spreading the cost is called depreciation or amortization. The charge of using these assets during the period is a fraction of the original cost of these assets. After all operating expenses are deducted from gross profits or gross margin, you arrive at the operating profit before interest and income taxes. This is often called income from operations. Income from operations. Interest income. There are taxes. Total expenses. Basic diluted, normalized income, interest income, and taxes. Next, company must account for interest incomes and interest expense. Interest income is the money company makes from keeping their cash in interest-bearing saving accounts, money market fund, and the like. And on the other hand, interest expense is the money company paid in interest for money they borrow. Some income statements show interest income and interest expense separately. Some income statements combine the two numbers. The interest income and expense are then added or subtracted from the operating profits to arrive at operating profit before income taxes. Finally, income tax is deducted and you arrive at the bottom line, net profit or net losses. Net profit is also called net income or net earnings. This tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? Then you have earning per share. Most income statements include a calculation of earning per share. This calculation tells you how much money shareholders will receive for each share of stock if they own for each share of stock they own if the company distributes all of its net income for the period. To calculate EPS, you take the total net income and divide by the number of outstanding shares of the company. And then a look is the cash flow statement. But it's okay. So far for this video, that'll be all for income statement because I just want to make a quick overlook of what income statement are, what it is. So it shows you is the revenue of a company made and the associated cost or expense with that earning. All right, in a period of time, yearly, quarterly, or some other portions. So this, the literal bottom line of the statement usually shows the company net earning or losses. I also look at something called the EPS, which is the EPS is the earning per share. Okay, the earning per share. To understand how income statements are set up, think of them as a stair. You define at the top of the total amount sales during the accounting period, yearly, quarterly, you name it, and then you go down step by step, and each step you make a deduction for certain costs and or other operating expenses associated with that revenue. And at the bottom of the stair, after deducting all of the expense, you can learn how much the company actually earned or lost during that accounting period. People often call this the bottom line. Okay? And at the top of the income statement is the total amount of money brought in sales of products or service. This top line is often referred to as gross revenue or sale. Okay, and then they started to describe that. So the top of the income statement is the total amount of money. Then you go down to all of this specific, right? I like the example they use. Think about the income statement as a stair, and you start from the top and go down. And anytime you go down each step of the ladder, or stairs. So each stair of the ladder here is similar as stairs. Okay, so each step of the ladder, you make a deduction from that. Okay, great. Well, that'll be all for this video. Take care. Bye bye.